Welcome guys to my channel. So this is our first video of this channel and I am your host Sharma, and this is our first video on the IND AS 109, which is a financial instrument. So this standard is very huge. It's almost 200 pages, and whenever you open that standards, it's like, oh my god, what the hell is this? 200 page. How am I gonna read all those standards? So therefore in this video we will discuss like the overview of the IND AS 109. We will not deep dive into it because it will take a lot of time to fully understand this standard. So we will overall cover the IND AS so that you can get the idea like what is written exactly in the IND AS 109. And also, while I will educate you about this standard or another standard, then I will also give you the para reference of that relevant standard, so that you can also prove to the other person like this is mentioned in this standard. So suppose like in this standard I will going to tell you like you have to now calculate the present value of the loan and put that figure into your balance sheet. So whenever someone will ask like why the loan is in the present value, then you will just say like those person on the internet is saying to calculate the present value of the loan, and that person will say where it is written, and you will just say, oh my god, where it is written, I don't know about it. That person is talking about this thing into the YouTube, I don't know where it is written, and that person will say shut the fuck up. So therefore I am going to tell you the para reference on my video so that you can also prove, and so that you can also check it out in the standard like where it is written that you have to calculate this much amount, that by using that method, so that that method can be easily cross-checked by the reference of the IND AS. So now, alright, so we should start our topic. So now first topic is like we will discuss here the overview. Overview is very important so that you can get the bird eye view of the whole standard. So this standard is basically divided into the 6 different chapters, and all the chapter is very different, which is different from one another. So therefore to read this standard you have to now break down the standard into the 6 segments, so that it will also mentally means you will just stay positive to read the standard, because when you will break it down into the 6 segments, if you read it like continuously, I'm betting you and I'm telling you that you will get nap and your motivation or your hope will die. I'm telling you that. So therefore it is very important that you bifurcate those standards into the different segments, so that you can also try to at least read it out. So now first segment or first chapter is about the objective, and it's very clear like what would be the objective of this standard. The objective of this standard is to calculate or to present the financial instrument into the balance sheet or profit and loss account or the other comprehensive income, so that the user of financial statement can get the idea like where and how it is presented. So basically the objective is just to get you the accounting principle of the financial instrument and how it will be reflected into the financial statement. Second one, what is the scope of this standard? So in the scope segment you will find like which kind of a thing will be included, or what kind of financial instrument is in this standard and what are get out of this standard. So basically, as the name suggests, this is the IND AS or standard on the financial instrument. So now you should know like what the hell is financial instrument. So if you will check like the definition of financial instrument, and the definition is not given into IND AS 109. The definition of financial instrument is given under IND AS 32, which is the presentation of the financial instrument. So when you will check out the IND AS 32, you will get the definition of the financial instrument. The definition of financial instrument is like that: financial instrument is any contract that give rise to a financial asset of one entity and financial liability or equity instrument of another entity. So those kind of a contract where you where it give rise to you financial asset, and to other entity the financial liability or the equity, it will be a financial instrument. So basically you don't get the idea like what the hell is financial instrument, because that definition is like a weird definition. So if you will check out the definition, so for understanding the definition, you should first know what is a financial asset and the financial liability. And when you will read out the definition of financial asset and financial liability, then also it will confuse you. Like the definition is quite long, but if you will break it down, then you will get the idea. Like the financial asset is any asset that is a contractual right to receive cash flow from another entity. When you have a contract and it gives rise to you to receive the cash flow, then that is the financial asset to you guys. And financial liability is a contractual obligation which financial liability is a contractual obligation to deliver cash or another financial asset to another entity. So when you are under the obligation to deliver cash or to deliver another financial asset to another company, then it will be a financial liability for you. So basically you are now confused because the language of this definition is quite confusing. So let me just tell you by way of example, like what is the financial asset and financial liability. The financial asset would be like cash, trade receivable, loan receivable, when you give the loan to someone and you are in a position to receive the contractual cash flow from that person. So loan receivable is also financial asset. Investment in share or bond. So remember that investment is also covered in this standard. Earlier it was under the accounting standard 13, but now accounting standard 13 or relative IND AS is not mentioned. So therefore accounting for investment would be covered in this standard. Accounting for investment in share or bond, not accounting for investment in properties. Like if you invest in the property of someone, like fixed immovable property, those will be covered into the separate IND AS, but the investment in share or bond will be covered with this standard. So that is also your financial asset. And what is not your financial asset, like the physical asset, like the inventory or the fixed assets, intangible assets, leased assets, income tax refund, prepaid expenses is not your financial asset. So when you will check like trade receivable, so if you check out this with the definition of financial asset, because trade receivable is giving you the right to receive the contractual cash flow from another entity, therefore it is a financial asset. If you will check out the financial liability, the example would be like trade payable, loan, when you receive the loan from someone and you are now in a contractual obligation to pay cash to another entity. Debentures, derivatives, derivative is also financial instrument. Redeemable preference share. And what is not the financial liability, like the income tax payable, VAT payable, advances from customer, provision for warranty is not your financial liability. So now I think it's now clear to you like what is financial asset and what is financial liability. So the scope is like this, and in the scope also there are a lot of exclusion which is not covered in this standard, like investment in subsidiary, associate and joint venture. So the accounting of those is not covered in this standard because that has a separate standard for dealing with that. And then the right and obligation under leased assets, so because there is also another standard which deal with this, so that is not covered in this standard. Then the employer's right and obligation under employee benefit. So basically that is a financial asset or liability, but the standard is itself saying that it is not covered in this standard because there is a separate standard for this. Then right and obligation under insurance contract, because that is also covered under separate IND AS. Then share based payment, another separate standard. Provision, contingent liability and contingent asset is also not covered with this standard. And there's also a lot of exclusion from this standard. So if you want to check it out, then read out the chapter number 2 relating to scope. If you have any doubt on any point, then comment on the comment section. I will reply it by way of a separate video. Now third chapter is regarding the recognition and derecognition. So it basically tell you like when to recognize the financial asset or financial liability into your books of account. So it says like you have to now record the financial asset or financial liability when you became the party to the contract enter into. So when you enter into any contract and that's give you the right to receive the cash flow or right or obligation to give the cash flow, then you have to recognize it into your books of account. So because we will discuss it in our separate video, so I will give you the example and all of this detail into separate video. But just for now, remember that it will be recognized when it give you when you become the party to the contract to receive cash flow or obligation to give the cash flow. And then also there is a principle of de-recognition, like when you can de-recognize the financial asset or financial liability from your books of account. So basically this is the chart which you can see right now into your screen. If you will check it, then you have to de-recognize your financial asset or financial liability, like when the contract, like when the cash flow from the contract has been expired, like when your right to receive the cash flow from that contract has been expired, and you significantly transfer all the risk and reward to another entity, and you have no effective control over the asset, then de-recognize it. We will see it when we will talk about this segment into our separate video. Now fourth one is important, that is the classification of financial instrument. So basically there is a three classification, like you have to classify the financial asset or liability into the three different segments. The first one is like amortized cost, second one fair value through other comprehensive income, third one is fair value through profit and loss account. So whenever you will read it, like what is the amortized cost and fair value through profit and loss, fair value through profit and loss, and other comprehensive income. So this is basically the classification criteria which is mentioned in section number or chapter number 4. So basically that chapter or section will give you like how to classify your financial asset or liability into these three classification. So basically there is a two principle, like business model test, contractual cash flow test. In the business model test, so when your intention is to hold down the asset, and the cash flow which you are receiving from that asset is solely payment of principal and interest, then you have to recognize it as amortized cost. Remember that. And when your business model is such, like you can either sell it or you can either hold it, and the cash flow arising from that contract is the solely payment of principal and interest, then you have to recognize it into like category like the fair value through profit or fair value through other comprehensive income. And in case your objective is like to sell it, or your like contractual cash flow is not the solely payment of principal or interest, or in any other cases, then you have to recognize it into fair value through profit or loss. So derivative is always recognized from fair value through other fair value through profit or loss account. Remember that. And those two cases, like example would be like loan. So when you gives the loan to someone, so because you know that you are not in a position, or you are not want to sell the loan to another entity, okay, and the cash flow which you receive from loan is the solely payment of principal and interest. So that will be example of these two cases, and that will be recognized at amortized cost. We will discuss like what is amortized cost and how to calculate it. So basically amortized cost is like you have to calculate the present value of the future cash flow which you will receive from that particular loan. So suppose you give the loan to someone and you are in a position to contractual cash flow, receive the contractual cash flow as interest and then the principal amount payment, then in both the cases you have to recognize it at the amortized cost using the effective interest method. And the effective interest method is just like the present value which you have already calculated into your classes like the financial management. So when you read the finance into your MBA or your CA or your CMA or other type of course, the similar thing is there. You have to calculate it at the present value. And suppose those cases where your intention is to sell out the assets, like you give the loan and your intention is to sell out those loan to another entity like the bank always does. In those cases it will be like fair value through other comprehensive income if the second condition would be satisfied, like the cash flow would be solely payment of interest and the principal. In all other cases like the derivative, always derivative will be classified into fair value through profit or loss account. So we will discuss it when we will discuss it in a separate segment. That's how it's gonna work. Next segment is the measurement. It's very important, and here it is all the calculation will be done. So now basically measurement, initially when you first recognize the financial asset or financial liability into your books of account, those cases will be measured, like initially it will be measured at the fair value. Initially it will be measured at the fair value, and you have to add or minus the transaction cost in case the classification would be amortized cost or fair value through other comprehensive income. In case of a classification would be like fair value through profit and loss account, then transaction cost would not be add or minus from that fair value. And fair value would be like you give the loan to someone and you charge the interest rate like the 4%, but actually the interest rate in an independent situation would be like 10%. So now you know that the loan is not a fair contract, so therefore you have to calculate the fair value by discounting at the rate of 10%, which is the fair rate of interest. So that's how you have to calculate the fair value, and you have to recognize the loan at that fair value initially when you first recognize it, and subsequently then you have to classify your financial asset or liability into the amortized cost, fair value through other comprehensive income, fair value through profit and loss account. And one more thing, in case of financial liability, the other fair value through other comprehensive income option is not there. You have to classify the financial liability into just amortized cost or fair value through profit and loss account. We will discuss it also, and we will discuss in a separate video. And in measurements also there is also concept of impairment. When you receive or when you think like your asset or liability is not in a position to get the cash flow or to obligation to give the cash flow, then you have to also impair. You have to also calculate the impairment loss or gain into that one. We will discuss it when we will check it out into the separate video. And then the last one is like hedge accounting. So last segment is the hedge accounting, and hedging is like when you are in the risk of something, like you are in the risk of foreign currency changes, you are in the risk of change in the interest rate, you are in the risk like your commodity will get expensive or price will be reduced. Then in those cases hedge accounting is there for you. There is a three type of a hedging accounting, like fair value hedge, cash value hedge, hedge of net investment in foreign operation. So we will discuss like in both three cases like how the accounting would be done. So basically the example would be like when you are at risk of change in the foreign currency, and you is receiving the foreign currency into now 3 months. So when you entered into the forward contract to receive the Indian rupees in exchange of US dollar 3 months from now, so now that is the you can say hedge instrument, and you have to deal those cases as per the hedge accounting principle. So hedge would be like like forward contract and future contract, interest rate swap, or some other means instrument which give you the right to hedge your hedge item successfully. And there's also concept like you have to like the hedging should be effective, qualifying qualifying criteria for hedge accounting. There's also concept. We will discuss it when we will fully cover it into our separate video. So that was a video which give you the idea of how the overview of this standard is. So if you have any query regarding the overview, you can ask me on the comment section and I will reply it by way of a separate video. So if you like the video, also like this video and also comment like how do you feel like whether it is informative or whether I should modify my teaching style so that you can get the more idea about how to properly understand those kind of topic. So I think I have delivered you in a very simple language, and that would be very helpful. And also when you will check out the IND AS 109 or IFRS 109, then it is divided into separate annexure. Like first one is like the IND AS 109 itself, but then there is also annexure A, which give you definition of the item or the words which is used in IND AS 109. And then annexure number B is regarding the application guide for the standard. So application guide is very long, very lengthy. So when you will check, like the basic accounting standard, basic IND AS is just like 40 or 50 page, but the application guide is very lengthy. And what is the exactly meaning or what is the use of application guide? So application guide give you the idea of the principle which is mentioned into the IND AS 109. Suppose example, like the IND AS is like for your betterment. So suppose you want to be successful, and the IND AS is saying you like you have to work hard for getting the success, but the application guide would tell you like you have to watch this channel's full video so that you can be successful. So like standard is saying you have to work hard, but the application guide is saying you have to watch full video so that you become successful. So therefore, how the application guide would just suggest you to apply those principles into the real situation so that you can get the better understanding of the whole standard. So therefore you have to read all those things combined together, but don't just confuse like the standard is 200 page. No, the basic standard is just 40 pages or 50 pages, something like this, but the application guide is very lengthy. So don't just lose your hope while reading out those standard. So that's how the case. And then the annexure number C, D and D is just also application of the principle which is mentioned into those standard. So that's how it's the overview of this standard. And in the next video we will discuss like recognition and derecognition, or we can also discuss about the scope, and then subsequently we will go into that segment. So if you also want to suggest something which I should cover in those topics, then comment on the comment section. I will include it into this video. Alright guys, so now it's the end. We will meet again in my another video. Till then, bye bye.